Welcome to the Personal Finance Podcast for Doctors. This podcast aims to simplify all aspects of personal finance and helps you make smart and informed choices about money so that you can live happier and stress-free lives. Today's episode is brought to you by Chanda Verma, who is a financial coach and vice president with the doctor practice at MFA, the only company in India having a dedicated practice for doctors.
Hi, today I want to talk about something very interesting. Let's talk about 4 different scenarios. A person called Dipali, she's a part of an investment club. She has achieved a respectable annual return of 12% on her portfolio. It aligns with her risk tolerance and her retirement goals. However, एक club meeting होती है and she learns that another person, Samir, who's a club member, he's achieved 18 or 20% return by investing in a very aggressive portfolio like a PMS. Now, despite her own success, Dipali is feeling unsatisfied. And now she is considering shifting her strategy to mimic Samir's, disregarding completely what is the risk involved. Now, there is also Madhu, a conservative investor, consistently invested in mutual funds and bonds, gaining steady returns, solid returns. One day she overhears a colleague bragging about making a lot of profit by flipping a property in the real estate market. Suddenly, Madhu feels her own investments are inadequate. Even though they suit her, they provide her the income stability she wants. But this feeling pressures her to consider real estate investments without understanding what is the risk involved. Now, there is Ajay, a young investor. He regularly follows financial influencers on social media platforms. People post about their investment wins. Many people, they just don't talk about their losses. Now, seeing these constant updates about lucrative stock picks and crypto fortunes, Ajay feels his own portfolio is not performing. This perception tempts him to make hasty decisions. He reallocates his investment to high-risk options which promise high returns, but also come with potential for significant losses. Let's look at Jyoti. She's very happy with her retirement savings progress. Now she attends a family reunion and her cousin boasts about doubling his investment in 5 years. Despite Jyoti's suitable investment strategy, she's feeling a sense of loss. She starts questioning her investment approach. She starts questioning her financial advisor. She considers investing in different investments too, overlooking the fact that her cousin's risk profile or the cousin's financial situation might be very different from her own. Now, in all these different situations, do you know what's common? What's common? It's your own behavior bias. And it is the single most important factor for successful investing. It's not the markets, it's not the timing, it's not the economy, it's not who is ruling your country, it is your own behavior. But as an investor, it's very natural to compare your returns with those of your peers, especially when you hear someone bragging about their returns. Now, this comparison, however, is a trap, and it is known as relative bias trap. And this bias doesn't just cloud our judgment, it can actively distort our investment strategy, push us towards unnecessary risks or changes. So what is this relative bias? You would have understood by now. It's very simple. You compare your financial achievements not on their own merits, but against the favorable outcome of other people. Your portfolio returns are 15%, you feel good. Then you hear your friend's portfolio is 24%. Suddenly, your success is inadequate. This isn't just harmless jealousy. It is a perception, and it can lead you to question your strategies, potentially driving you to impulsive decisions, switch advisors, shift to higher risk investments in an attempt to match or outperform others. And trust me, this is common. It happens to the best of us, to the most seasoned of investors. Now, so what should you do when this happens? Number 1, always focus on your goals. Your financial goals are the front and the center for you. Investment should be tailored to personal circumstances, including your risk tolerance, your investment horizon, your financial needs, not based on someone else's success. Number 2, think long term always, because investing is a marathon, it's not a sprint. Short-term fluctuations happen, short-term comparisons happen, but they are less relevant when you focus on long-term growth and stability. Therefore, regularly review your strategy with your finance professional. Possibly adjust your strategy based on changes in your life, not due to comparison with others. Third, literacy. Understanding the markets, understanding the nature of investing can help you against emotional responses to other people's success stories. Education helps in appreciating the complexity of different investment strategies and why certain choices are right for one person and may not be for another. And most important, the fourth point, understand yourself. In the journey of investing, understanding yourself is more crucial than understanding the market. It's about comprehending your financial goals, your deeper motivations, your fears, your biases that drive your decision making. This is self-awareness, and this is the anchor of your behavior. It means you're recognizing your behavior patterns, your emotional responses to market changes, your psychological biases that may influence you. Are you someone who feels the need to change your investment strategy just because your family member has earned higher returns? Or are you someone who panics during a severe market downturn? Or do you find yourself always chasing performance? When you're aware of these traits, it allows you to develop strategies to accommodate them or counteract them. So, the key takeaway of today's episode is that you have to recognize your feelings when it comes to investments. And these feelings are influenced by this relative bias. Recenter your personal financial goals, and then you can avoid the pitfalls of this deceptive mindset and maintain a steady course towards your objectives, not get swayed by success of others. By knowing yourself, your triggers, your tendencies, your true objectives, you set the stage for choices which are conscious and deliberate. It is your personal reality. Have the courage to face your financial fears. Have the discipline to adhere to your investment principles, even when the world around you seems to be chasing the wind. Because your investment journey is unique to you, much like your fingerprint. I hope this helps you. Thank you so much.
You were listening to the Personal Finance Podcast for Doctors with Chanda Verma. If you find this podcast relevant and interesting, do share it with other doctors as well. It will be great if you leave a review, share, like and subscribe. You could also let us know if there is any specific topic that you would like us to cover. For any queries or help, you can get in touch with MFA's Doctor Practice Team at 892-800-6140.